Institutional volume just spiked 43% on ENPH. Wall Street sees policy risk. The engineering reality is a hardware ceiling break. Fear is hitting 27, and one call today might surprise you. By Enphase Energy, Lab score 63 out of 100. Institutional volume surged 43%. Signaling smart money is loading up as Enphase breaks its hardware bottleneck with IQ8 microinverter mass production. The shift to DC-coupled storage solutions is expanding margins by 180 basis points despite 22% tariff headwinds on Chinese assembly. This isn't a solar play, it's a distributed grid compute bet the market hasn't priced in yet. Enphase 13% rally is a technical breakout masking a brutal 80% revenue collapse caused by the transition to their custom ASIC, application-specific integrated circuit, a chip designed for one specific task, which now defines their margin floor. The IQ8 microinverter relies on a 55-nanometer process node, the physical size of the transistors etched onto the silicon, to manage high-speed power switching. While Tesla's Powerwall uses a central string inverter, a single unit converting power for the entire solar array, Enphase places an individual brain on every panel. This distributed architecture requires 99.9% reliability across thousands of discrete components. The PowerMatch expansion is a hardware validation of their bidirectional GaN, gallium nitride, a semiconductor material that handles higher voltages with less heat than standard silicon. The engineering bottleneck isn't the software, it's the TDP, thermal design power. The maximum heat a component is designed to dissipate, of the microinverter housing. At $52.97, the market is pricing in a recovery of 45% gross margins, yet the hardware reality is a diluted EPS. Earnings per share, the portion of profit allocated to each stock, of -6 cents. We are tracking the transition to the IQ9, which moves to a GaN on silicon architecture to reduce switching losses and heat by 50%. Despite the RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, hitting 77.5, the physics of their grid-forming silicon creates a moat that string inverters cannot cross. Today's move proves the market finally values the silicon architecture over the solar macro. Quarterly financials showing modest revenue momentum for ENPH. Enphase Energy is currently caught in a violent squeeze as the 4.61% 10-year yield, the benchmark interest rate for long-term debt, collides with a massive 27.7% short float, the percentage of shares traders have bet against. The lab views this 13.3% surge not as a fundamental recovery, but as a mechanical reaction to a normalizing yield curve, the transition where long-term rates finally rise above short-term rates. For a company with negative 20.6% revenue growth, the Fed's 3.64% rate is a high-voltage fence. While the 0.6% CPI, Consumer Price Index, which measures the average change in prices paid by consumers, suggests inflation is dead, the cost of financing residential solar remains prohibitive. We are watching the Fed Chair Kevin Warsh era begin with threats of further hikes to appease bond vigilantes, investors who sell bonds to protest inflationary policies. This monetary friction is the primary barrier to Enphase capital expenditure recovery. The geopolitical landscape is shifting from a tailwind to a structural blockade as the Trump administration reignites trade wars over Greenland and broader global markets. New tariffs, taxes imposed on imported goods, are no longer a threat. They are the baseline for 2026. Enphase faces a dual-front war, rising component costs from potential 60% China tariffs and a cooling social sentiment toward ESG, environmental, social, and governance, a framework for evaluating a company's sustainability. With recession risk priced at a low 4.7% by prediction markets, the market is betting on a soft landing, yet the 1.25 beta, a measure of a stock's volatility relative to the S&P 500, means Enphase will overreact to every tariff headline. Analysts are desperately trying to find a floor, but the macro reality is a pivot from green subsidies to protectionist industrial policy. The era of cheap solar credit is over. The era of the trade war premium has begun. ENPH reported earnings per share of $0.47, beating the Wall Street estimate of $0.42 by 12.2%. A solid beat that signals strong execution. ENPH is trending higher, currently at $52.97. Enphase just dropped a press release touting PowerMatch expansion into North America. Solar inverters that now talk to home batteries with AI-driven efficiency. That's the glossy headline. But let's talk about the 137,250 shares insiders net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives are dumping six-figure blocks while the company trumpets expansion, it's not confidence, it's liquidity. Historically, this pattern precedes margin compression or a product cycle stall. They're not selling because they love the stock. They're selling because they see the balance sheet reality before Wall Street does. EPS beat by 12.2% last quarter, 47 cents versus 42 cents, so the street cheers. But dig deeper. R&D spend dropped 6.1% year over year while revenue grew. That's not efficiency, that's a pipeline on life support. When R&D growth lags revenue, management is choosing margin over innovation, and that's a bet against future demand. Now listen to the language. AI-driven efficiency sounds cutting edge, but it's code for we're not spending on next-gen silicon. What the lab hears isn't innovation. It's a company papering over a product gap with buzzwords. The 10Q would flag supply chain concentration and customer concentration risks. Management's PR just calls it optionality. That's not strategy, that's spin. The momentum breakdown for ENPH. RSI sits at 77, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Enphase is finally breaking the hardware ceiling as institutional volume surges 43.7% above the 20-day average. The bull case rests on the cup and handle formation, a technical pattern signaling a trend reversal, and the massive leverage of the Inflation Reduction Act. They're microinverters, devices converting DC power from panels to AC for home use, are now high-margin gatekeepers of the smart home. But here is what breaks the bull thesis. The 52.4x trailing P/E, price-to-earnings ratio, demands flawless execution, while the RSI, relative strength index measuring price momentum, sits at a dangerously overbought 77.5. If semiconductor supply chains choke or interest rates pivot, that forward P/E of 21.7x vanishes. We are seeing a massive 0.27 put-to-call ratio, suggesting the market is blind to the 200-day moving average resistance at $39.44. The question every professional must ask is, can Enphase maintain its premium pricing as microinverters face commoditization from integrated Chinese alternatives? The lab's answer is no. Hardware moats are temporary, and the current 97% rally from annual lows is pricing in a perfection that the silicon supply chain rarely delivers. Management is pivoting to smart home language because the raw inverter margins are under siege. The lab's verdict. With an AI score of 63, we are not chasing this vertical move. Watch the $52.97 resistance level with surgical focus. A failure to break out here sends us back to $31.19 support. Enphase is a hold until the technical heat cools. Enphase microinverter margins are expanding despite tariffs. 63% score confirms strength. Is Enphase quietly winning the solar war while competitors bleed on logistics? Sound off below. We're engineers, not advisors. This is for education, not recommendations. Do your own homework. Markets shift. History doesn't guarantee outcomes. Until next time, stay sharp and keep building.